Common pitfalls. Understanding why many investors lose money. In the world of investing, success stories often grab headlines. The visionary who strikes gold with a timely investment, or the shrewd trader who navigates market volatility to multiply their wealth. Yet behind these triumphs lies a stark reality. A significant number of investors find themselves on the losing side of the equation. From psychological biases to market complexities, understanding why 70% of investors experience losses sheds light on the intricate dance between risk and reward in the financial landscape. Stick around to learn practical tips and strategies to avoid these pitfalls, so you can tilt the odds in your favor and achieve financial success. If you're ready to take control of your financial future, hit that subscribe button and join our community. Let's dive in. Number 1. Lack of proper education and research. A lack of proper education and research is a significant factor contributing to why 70% of investors experience financial losses. Many individuals enter the investment arena without a solid understanding of financial principles, investment strategies, and the risks involved. Without this foundational knowledge, investors may make uninformed decisions based on tips, rumors, or emotions rather than on thorough analysis. Moreover, inadequate research can lead investors to overlook key factors that affect asset prices and market dynamics. Without understanding the fundamentals of the investments they make, such as company earnings, industry trends, or economic indicators, investors are more susceptible to making poor choices that lead to losses. Successful investors prioritize education and continuous learning about financial markets and investment strategies. They conduct thorough research before making investment decisions, seeking reliable sources of information and advice. By understanding the risks and potential rewards of different investments, they can make more informed choices aligned with their financial goals and risk tolerance levels. Addressing the educational gap in investing through accessible resources, reputable guidance, and ongoing learning opportunities is crucial for improving investor outcomes and reducing the prevalence of financial losses in the market. Number 2. Emotional decision-making. Emotional decision-making plays a pivotal role in why 70% of investors experience financial losses. When faced with market volatility or unexpected developments, many investors react impulsively rather than sticking to a well-thought-out strategy. Fear of missing out, FOMO, can lead to buying at market peaks, while fear of loss can prompt selling during downturns, locking in losses. Conversely, euphoria during bull markets can fuel excessive risk-taking without considering potential downsides. These emotional responses often override rational analysis and long-term planning, undermining investment success. Investors who let emotions guide their decisions may neglect diversification, ignore fundamental indicators, or fail to rebalance their portfolios appropriately. Overcoming emotional biases requires discipline, a clear investment plan, and adherence to predefined goals and risk tolerance levels. Educating investors about behavioral finance principles can empower them to make more objective decisions, improving their chances of achieving sustainable and profitable investment outcomes. Number 3. Lack of diversification. The lack of diversification is a critical reason why many investors face financial losses. Diversification involves spreading investments across different asset classes, industries, or geographic regions to mitigate risk. When investors concentrate their funds in a single stock, sector, or market, they become highly vulnerable to the performance fluctuations of that specific asset. For instance, putting all capital into a trending stock can yield substantial gains if it rises, but can lead to significant losses if the stock declines sharply. Similarly, focusing solely on a particular industry or geography exposes portfolios to sector-specific or regional economic downturns. Successful investors recognize the importance of diversification in reducing overall portfolio risk. By spreading investments across various assets, they aim to balance potential losses in one area with gains in others, smoothing out overall returns and enhancing long-term stability. Lack of diversification often stems from a lack of understanding or overconfidence, highlighting the importance of education and strategic planning in investment management. Number 4. Poor timing and overconfidence. Poor timing and overconfidence are significant contributors to why a large proportion of investors experience financial losses. Poor timing occurs when investors make buy or sell decisions based on emotional reactions or flawed market timing strategies. For example, investors may buy into assets at inflated prices during market euphoria or sell during market downturns out of fear, locking in losses instead of waiting for potential recoveries. Overconfidence amplifies these issues by leading investors to believe they possess superior knowledge or skills, which can result in excessive risk-taking or neglect of fundamental investment principles. Overconfident investors may concentrate their portfolios in high-risk assets, ignore diversification, or fail to conduct thorough research before making investment decisions. Both poor timing and overconfidence undermine disciplined investment strategies that emphasize long-term planning, diversification, and risk management. Successful investors mitigate these biases by sticking to a well-defined investment plan, avoiding emotional reactions to market fluctuations, and continuously educating themselves about financial markets and investing principles. Addressing these behavioral biases through investor education and promoting disciplined investment practices can help reduce the prevalence of financial losses among investors and improve overall investment outcomes. Number 5. Market volatility. Market volatility significantly contributes to why 70% of investors experience financial losses. Volatility refers to the rapid and unpredictable changes in asset prices, influenced by various factors such as economic data releases, geopolitical events, and investor sentiment shifts. Sudden market swings can trigger emotional responses among investors, leading to irrational decision-making such as panic selling during downturns or impulsive buying during rallies. Investors who are unprepared for market volatility may experience significant losses, especially if their portfolios lack diversification or risk management strategies. High volatility can lead to heightened uncertainty, making it difficult for investors to accurately predict market movements and adjust their strategies accordingly. Successful investors recognize that market volatility is a normal part of investing and plan accordingly. They diversify their portfolios across different asset classes and geographic regions, maintain a long-term perspective, and implement risk mitigation strategies such as asset allocation and hedging. By understanding and managing the impact of market volatility, investors can navigate turbulent financial markets more effectively and improve their overall investment outcomes. Number 6. Chasing losses. Chasing losses is a common behavior that contributes to why many investors experience financial setbacks. When investors experience losses in their portfolios, there's a natural inclination to try to recover those losses quickly by taking higher risks or making aggressive investment decisions. This behavior is driven by emotions such as fear, frustration, or the desire to break even. However, chasing losses often leads to further losses rather than recovery. It can result in impulsive trading, disregarding fundamental analysis, or deviating from a well-defined investment strategy. This reactive approach can exacerbate losses and increase portfolio volatility. Successful investors understand the importance of discipline and patience in investment decisions. They avoid emotional reactions to short-term market movements, stick to their investment plans, and focus on long-term goals rather than trying to recover losses quickly. Educating investors about the pitfalls of chasing losses can help them make more informed and rational decisions, improving their overall investment outcomes over time. Thanks for watching. I hope you found this deep dive into why many investors struggle with losses insightful. If you enjoyed this video, please give it a thumbs up and share it with anyone who might benefit from this information. Don't forget to hit the subscribe button and click the bell icon so you never miss out on our latest tips and insights into the world of investing. Have you experienced any of these investment challenges? Share your stories or questions in the comments below. I'd love to hear from you and continue the conversation. Thanks again for watching, and happy investing!